Good. Well, so a bit of an overview for the two companies, first of all, for those that didn't listen to the podcast and haven't seen you on stage before, Jamie. Eigen Risk, you're based in the US, founded in 2014, Deepak, offering catastrophe risk and analytics platform, so big theme just now, platforms for basically everybody that's involved in the transaction and underwriting of risk, brokers, risk managers, insurers. You're helping them with underwriting, helping with exposure management and claims response. It's going to be quite a big topic today. And this whole theme about blind spots, going to be talking a bit more about what that means, but that's on your tagline, identifying blind spots. Using real-time data, we're going to be talking a bit about that, hearing some real cases of companies using that real-time data to assess their hurricane risk. Sophisticated modeling, but as we talked about in the podcast, not so you're taking the sophisticated modeling and making it straightforward for the underwriters to use from third-party sources. Jamie, Riask founded in 2018. And you're providing high-resolution weather risk analytics and forecasting to help people understand both severity and frequency of extreme weather events, something we're all very focused on right now. You've got multiple data sources. You're providing dynamic, forward-looking representations of atmospheric risk. And middle of last year, you raised funding. You're now in excess of $6 million. So, Deepak, blind spots. When you talk about blind spots, can you just explain what are underwriters not able to see that makes them blind?
Came up with the term blind spots because we used to get this question a lot in the early days about why do we need you guys? We already have a CAT modeling strategy. We use RMS, AIR, the typical models, and most insurers, MGAs in this day and age have a strategy, and I liken it to you're driving. It's rightfully what you're driving towards, and it's the core of your strategy. But it's the surprises that still continue to get us. It seems like every year. I mean, anybody who was just last month with Beryl, anybody experienced that sense of anxiety every time there's an event? That means there's obviously some aspect of the problem that's still a blind spot. So the way we think about it is that there are, while pricing and capacity allocation are sort of fairly mature areas, use cases where there's good strategy in most companies. The areas we see that there are blind spots is really accumulation monitoring and exposure management, event response, both from the estimation side and the claims management side. Even customer engagement, we found that companies are starting to figure out better ways to engage their customers using platforms like ours and using data from partners like Riask.
So 3 areas now we'll be talking a bit more about. So the accumulation management, so basically perennial problem for insurers, working out across different lines of business, different styles of data. How do you bring those all together? So one blind spot is you just don't know the fact that you might be exposed to the same client, but through different lines of business. Second one, exposure management, which is actually what happens when the event happens on the ground. Again, still, I think, surprising for many people how little we actually know. We're going to hear a bit about that. And then interesting on the whole client engagement one, we're actually going to be talking a bit more about that as well. But it's helping people actually find out underwriters how to talk to their clients and which clients they should be talking to after the fact.
Yeah, so I think on the client engagement side, we've got some of our customers who are sending alerts to their customers. So even though previously you're spending a lot of time internally trying to understand losses, but being able to provide your customers some insight at the time of an event, whether they use it or not, is a great way to just be front and center outside of the renewal cycle.
So just getting us a bit practical then. So as most of us will be aware, Hurricane Beryl, earliest Cat 5 hurricane event in the year, gave people a bit of a fright. Ultimately, it was quite small and it went over the US, but quite significant in the Caribbean. What kind of things, just making that specifically, in terms of event response and the loss estimate? So we talked about event response, which is what you do sort of immediately after the event, and then how do your clients work out what their loss is going to be? What specifically do they coming to you for on those blind spots, and where are you sort of where are you sort of shining the light on those blind spots with data you're accessing?
Yeah, so we'd like to think in the context of event response, it depends on who you are. So we service actually the entire ecosystem, so all the way from risk managers to brokers to insurers and then to reinsurers. So there's use cases for what to do before the event, right? So as the forecasts are coming in, and that's I'm sure we're going to talk about Psych here later today. Even when Beryl was coming in, we're trying to give them information on more actionable forecasts. So everybody does the cone of uncertainty and the track, but we get wind speeds from the partners like Reask, and we're able to quickly overlay that on your portfolio, give you an early estimate of what your losses could be, as well as individual location, what wind speeds or what probabilities are at individual locations, so you can make the decisions faster, right? So all the way from that's pre-event. And then once it does make landfall, then you're looking for the best information about what actually happened, all the way from estimating losses to even looking at imagery before and after. And the goal is to get the best possible estimate of loss, so you can have a much better idea of your reserves, right? You're just reporting out your estimate. So I think we're going to cover that later in a little bit more detail too.
Yeah, I mean, and you come to this, it's not purely an intellectual exercise. You were building models yourself. You were a broker, so you've actually seen where some of the problems are, and presumably also kind of have a pretty good view as to who to go to for the quality third-party data as well. So if it's part of your role at EigenRisk to be the kind of curator of third-party data for your clients.
Yeah, I think a lot of this comes from my own experience, building models. And I think the word model typically is synonymous with the big probabilistic models with a lot of detail and a lot of uncertainty that gets modeled. And I think the problem is when you try to use models in the context of live events, suddenly there's a disconnect there, right? So they're not designed to give you the best estimate for a single event when the frequencies are not involved. So it's a little difficult to hide behind the idea that, hey, the large aggregates will give you a good enough result. And so that's why it's just much better to kind of go back to the basics, and that's what our platform does. Is we do actually much simpler deterministic modeling, and we really focus a lot on let's get the best possible view of hazard, and then have simple assumptions on top of that on damageability, and then finally we have a full financial model that puts it all together, so you get an estimate that you can actually, it's not a black box, right? So you're able to actually query it and tweak it and adjust it.
Right. So Jamie, talking to you, so Reask was founded in 2018. It feels like you've been around a lot longer. That's a compliment, by the way. When we've been talking, you've made this point about the difference between event data and risk analytics. And again, clearly, as we're now in hurricane season, for many people, I think they look at an event and it's just an event, but there's a lot more complexity to understand. Can you just talk a little bit about what is that differentiation between risk analytics and event data?
So you missed the really, really salesy bit of world's best analytics data. I shouldn't have slipped you that tenner downstairs. No, but I think distinguishing between events and risk is a good intro into what we've done as a business. I can't take the credit for this, but Thomas Loridan, our co-founder and chief science officer, published a paper in 2017 that was all about understanding the individual event characteristics for individual tropical cyclones. Now, for the modelers in the room, you will know that we fit Holland profiles, Willoughby profiles, exponential shapes. If you look at a tropical cyclone on a weather forecast, maybe those non-scientists in the room can appreciate that they're very complex. They're not symmetric. They don't look like exponential functions. So Thomas said, I can do a lot better. I can leverage advances in AI. I can leverage advances in numerical weather prediction and modeling to train AI algorithms on proprietary data sets to model individual events better. And I think some of the people on the panel today will talk about how some of that granularity and accuracy at an event level is being leveraged for things like parametric. I think it's going to be some people on a panel talking about how Reask data is leveraged. And then once you understand an event at an event level, which is quite limited in existing modeling, it's then, okay, can I simulate these events in different environments that can tell me things about what could happen? And that's the second thing that we did. And that's the risk analytics part. So if you know events at very, very high granularity and detail, you can then simulate them in different climates to then tell you, okay, across the whole risk curve, how likely am I to have a Cat 5 in Florida under different climate conditions? How likely am I to have a Cat 4 in Florida and a Cat 1 in New York from the same event? Am I more or less likely to have bad seasons in Japan and bad seasons in the US at the same time? That's the risk part, assigning some probability or likelihoods to these events that could happen. And that's been a big focus for us in the last 5 years. And I think it's also part of our relationship with EigenRisk is if you've got this event level stuff, which is almost at the start, you've got this risk level stuff, which is all this stuff that could happen. Now we can create these data sets that allow people to quantify this uncertainty in between. which is a huge value add that we bring to the market. But we focus purely on events and risk.
So just to put that into the layperson's language, and after 35 years in catastrophe modeling, I should know the answer to this, but I might be wrong. So it would be a sort of example to say, if you look at the population of London, you get a massive distribution in size and age and height, and so we don't just get 4 types of people. Is that, and so you're saying with the hurricanes and cyclones, with Thomas's paper, essentially he's looked at all the different variations of hurricanes, and I feel I got this right, have I? So you get like a population of people, everything's different, and then the trick, I guess, is now to Deepak's point, when you start to get real events, then you have to sort of work out, well, who was that? Was it Joanna from EC4, who is the hurricane equivalent? Is that basically a good analogy?
Yes, maybe. If you have a tropical cycle, a good example of this is probably Hurricane Ian that made landfall in Florida a couple of years ago, is that it looked like it was going to hit and be a characteristic event, which is maybe your normal distribution of how you expect things to be. Maximum wind speeds on the right, okay, looks pretty nice. The event happens, but it was totally opposite. The maximum wind speeds were on the left, which for those in the room who aren't modelers is actually very rare. So we were able to capture that, which I think only 2 people in the market were able to capture. And if you had just assumed this normal characteristic of an event, you would have got it wrong. And I think really the value of what EigenRisk brings is we're probably the first people to tell you that, I mean, we've got 40% PhDs in the business, RMS people, all inquisitive. We love to talk wind speeds and probabilities. And I think there was a sentence that you used at the beginning is, how do you translate that to an underwriter? If I start talking in wind speeds and probabilities to an underwriter and he starts talking to me in loss cost, we might as well be talking 2 different languages. I think the value of the EigenRisk platform sits in the middle that says, the RIOS wind speed says this is what it means for this particular use case, whether it's underwriting, loss cost, how is it going to affect my portfolio, how much should I reserve, which allows us to then say, and I was joking to say best in class, it allows us to, with the ambition to be the best in class risk data for tropical cyclones, and we're expanding into other perils globally.
Good. Well, you've got some underwriters in the room. You can go and have a conversation with them at the break. You see if you're talking the same language, or you can maybe bring Deepak along to translate it.
Well, I was just going to say that I'm actually guilty as one of those PhDs who made life a little too complicated for a lot of folks in the first half of my career, and I'm trying to atone for it with EigenRisk in some way. But yeah, it's interesting you mentioned Ian, because that was one of the things, like, it was kind of eye-opening, because when you look at what's out in the news, and people talk about hurricanes with these tracks and cones, and really what matters is the wind speed, and not just the wind speed, but the gust, because that's what causes damage. I mean, that's what that matters. And when you look at the detail that a Reask footprint brings in a platform like ours, where you can see them side by side, it's a night and day. So you could be using something that might look like it's giving you a number, but it's not. When you can see it and look at the impact on on your loss estimates, and then validate it with when the claims come in, it becomes much more apparent.
That's a key point, and it's something that I guess we can give ourselves a pat on the back, especially the modelers, is that once you have this granular data and you start looking at it and you say, okay, let me have a look at my claims history, and you go, I wonder why I was getting such high claims in that location. And you look at a RIOS footprint and you put your claims over the top and you go, it's because the wind speeds were higher there. So even the fact of having better data just starts to unlock more value as you start looking at new things that interact with it, and you start to unearth correlations that you never saw before. And we were kind of surprised a little bit. You shouldn't be surprised if you're building this data and you expect it to be good. But when our customers start looking at claims or start looking at how wind speeds impact other phenomenon, you start to actually, it's a pretty good predictor, but it should be. It almost validates that what we're doing is actually pretty good.
Right, and you've got a product called Live Psych. I can sort of guess by the name, but just want a quick description of what Live Psych offers.
We've done this thing that we like to put Psych on the end of every product. Deep Psych, Live Psych. I don't know what we're going to do when we have drought or fire. But it's a new product, again, sort of sitting in between this event level stuff, which is, okay, an event comes along, what's the best estimate of the wind speed? And this risk space, which is what could happen. There's this avenue in the middle that probably as an industry we haven't been reactive to, or maybe we haven't been proactive around. I mean, our industry is very much supply-demand driven. An event happens, do rate, change your underwriting profile. We said, okay, if we can model events really accurately, and we understand the risk around where tropical cyclones could go, we could create a 3 to 5 day early warning system. that gives you an approximation of the best estimate wind speed at any 1 kilometre wind at site location, even when the storm's on the water. And again, this starts to unlock new value that we couldn't do before, right? Because even if you're an insurance company, we kind of thought, if we talk to an insurance company, they might not care that much because they're always like, we just put premiums in, get on the horse and wait. But actually, some first movers are starting to say, well, actually, we can use that to get ahead of the demand for loss adjustment expenses. So we can start preparing before an event. And there was a report, I don't know if anyone's read it, that was released last week, Monday, it was a combined between Allstate and the US Department of Commerce, which was all about the cost-benefit relation of if you spend dollars up front, you will save. And actually, if you're prepared before an extreme weather event, that cost-to-benefit ratio can be 1 to 13. And I think once we start unearthing these new data sets, which probably from a more academic sort of internal process from our perspective, we just do these things because we think they're cool. But then all of a sudden, these things start to say, we can use it like this, and you talk to customers and say, actually, yeah, we could accelerate our loss adjustments expense ahead of time and actually reduce cost. So we're hoping alongside with EigenRisk that we can start to unlock new value that can start saving on insurance claims even before an event happens.
Good. Well, thank you. Well, we're going to hear some of your clients and some other people in the industry that have also been thinking quite hard about this. So Deepak, please stay on stage because we're going to meet from a couple of your clients. Jamie, you're going to hear from Reask.
Thank you very much.
Thank you very much.
Cheers.